Hello and welcome back to our lecture on quantitative risk management. We stopped last week with the multivariate volatility models, and what we are trying to do now is we want to extend our previous thoughts on univariate volatility models, most notably the Gauge and Arch models, to the multivariate case. So we have now several random variables, we have random vector, and we do not only have the volatilities and conditional volatilities of each of these time series, but we also have conditional covariances, correlations between x1, x2, x3, and so on. And these need to be modeled in multivariate volatility models as well. So the starting point is a univariate model to represent the volatility of one time series. So yt is modeled as sigma t times zt, where zt are random innovations, for example, from a t or from a normal distribution. Sigma t are the conditional volatilities. By the way, why are they conditional? They are conditional because they are time varying. They are time dependent. So it's sigma t. And this is what is conditional about them. And if we now look at, say, 1, 2, 3 up to k securities, we write this above equation as ytk equals sigma tk times sigma ztk. And then the conditional covariance matrix of these returns is given by covariance matrix sigma t, and the entries of this matrix are simply the covariances between yti and ytj. So we are choosing two variables, one at a time, I and j, and if we calculate the covariance between these two return series, this is one entry in the variance covariance matrix sigma t. Okay. A very simple first model in this context of multivariate volatility model is the so-called exponentially moving average model, the EWMA model. The exponentially weighted moving average model assigns exponentially decreasing weights to the data points of the data series. Thus, more recent data that are more recent and don't lie back in time too much, those more recent data points are weighted more strongly than older data points. Those older data points slowly fade out of this estimation, and the univariate variant is simply sigma t hat squared. So the estimated variance is given by lambda sigma t minus 1 squared plus 1 minus sigma yt minus 1 squared, with a known assumed weight lambda. In the multivariate version now, you simply have to substitute the variances by the variance covariance matrix sigma t. So you get sigma t equals lambda sigma t minus 1 plus 1 minus lambda, and then this product of yt minus 1 with itself. So it's actually this vector squared. Now the model can be determined and estimated by separate estimation of sigma tij, so the entry in the variance covariance matrix sigma t. Each entry is given by lambda sigma t minus 1 ij plus 1 minus lambda yt minus 1 I and yt minus 1 j. And this exponentially weighted moving average model has the advantage that it can be estimated relatively quickly. It's rather simple, and the resulting covariance matrix is always positive semi-definite. Now, to introduce the following models, especially the multivariate versions of a Gauge model, we first have to define white noise. In the multivariate case, we've already seen this in the univariate case, but we need white noise, strict white noise, and strictly stationary in the multivariate case. So we call xt a multivariate white noise process, also known as a multivariate strict white noise, if it is a series of independent, identically distributed IID random vectors. So they need to be independent and distributed according to the same random law. For such a process, there is no cross-correlation because of the stochastic independence. All those correlations are zero. And because of this cross-correlation between any components of the series for any lag greater than zero, for zero, obviously, we have the variances. They can be non-zero because otherwise we wouldn't have random vector. But for any lag greater than zero, like 1, 2, 3, and so on, because of the stochastic independence we assume for this white noise process, those cross correlations are zero. And we will denote a strict white noise process with mean zero and covariance matrix sigma by Wn0 sigma. Now, strict stationary in the multivariate context of this time series xt, we call this strictly stationary if xt1, xt2 up until xtn has the same distribution as xt1 plus k until xtn plus k. So again, for all lags k, element of the whole numbers, and all n, natural being natural numbers for all time points, if the distribution of xt is the same as this time series simply lagged by k time points, then we call this time series, this multivariate time series, strictly stationary. So next we can look at VARMA and ARMA models. So ARMA models can be generalized to higher dimensions, and we then call these vector autoregressive moving average or VARMA models. Now, among the VARMA models, the Var model, vector autoregressive model, is most widely used in practice, and the first order Var model can be expressed in form of the following simple equations: xt equals phi times xt minus 1 plus the innovations, the disturbances, and epsilon t follow a white noise process, and phi is a time invariant matrix. This is actually a matrix of those parameters we need to estimate. So as you can see, this is basically the same as the AR1 process, simply now formulated with a vector, with vectors and matrices. So this is a vector autoregressive model, a Var model. We can then move on to a multivariate gauge process. So let ZT be a white noise process with zero mean and unit variance and covariances, mean vector 0, where the d components are uncorrelated and the variance of each component is equal to 1, then a process xt is set to follow a gauge process if it is strictly stationary and follows from xt equals at times zt. Zt again are the disturbances, and at times at transposed is equal to the variance covariance matrix. So again, in the univariate case, would have written sigma t times the disturbances here. Now we take the matrix that actually is part of this decomposition of the variance covariance matrix. By the way, this element of the whole numbers has to go in here, obviously. Okay, so this is multivariate gauge model. We have at times at transposed, forming the variance covariance matrix, the conditional covariance matrix, and then it is multiplied with this white noise process. Okay, you can then also add a conditional mean term, mu t, such that you get xt, the multivariate time series, is equal to phi t plus the gauge component. You can also set the conditional mean constant. You could also use mu t following a VARMA specification. And what you can then do is you can take the variance covariance matrix that is inside this matrix AT, and it can be rewritten in the form sigma t equals delta t times pt times delta t. Delta t is the diagonal volatility matrix, and pt is the conditional correlation matrix. So you're moving and transforming the variance covariance matrix and splitting it up into the conditional volatilities in delta and the conditional correlations in the matrix P. Now, I already mentioned that the innovations, the disturbances, the error terms that are used here in ZT, that these are assumed to follow a white noise, that these are assumed to be a white noise process. White noise doesn't tell you which distribution they follow, and you can actually choose a multivariate Gaussian distribution, a spherical multivariate t-distribution. In practice, it's most of the time a skewed t-distribution that fits the data best, because it's also the one that is most flexible. But in essence, you can use any distribution with a mean zero and covariance matrix equal to the identity matrix ID, but still in practice, as I said, usually it's a skewed t distribution that is most flexible and that fits empirical data best. Okay. Next, we want to look at the constant conditional correlation model from Tim Boller's lab from 1990. It's a CCC gauge model. It's a special case of a multivariate gauge model where the conditional covariance matrix has a very peculiar structure, and the structure implies that the conditional covariances are proportional to the conditional volatilities. And more formally, in the CCC model, the conditional covariance matrix sigma t hat consists of the constant positive definite correlation matrix R hat and the diagonal matrix of the conditional volatilities, such that sigma t has the structure dt times R times dt. So if your variance covariance matrix looks like this, you have a CCC model. Constant conditional correlation. The correlations are constant. The volatilities are time varying, so this is why they're indexed with a t, whereas R, the volatility, the correlations, they are constant, hence the name. Now, how do you predict this? You predict sigma t equal to the volatility matrix times correlation times time varying volatilities, with dt being this matrix. Obviously, you have on the main diagonal, you have the volatilities, the conditional volatilities, and zeros for the rest of the entries. And the individual volatilities each follow a gauge process, and then you estimate this in this particular form. Now, the CCC model is relatively easy. It has the disadvantage that the correlations are assumed to be constant. So even though you have time varying volatilities, and this gives you, in modeling purposes, this gives you a lot of flexibility when it comes to financial data, the correlations are constant, assumed to be constant. And in real life, especially with empirical and financial market data, obviously the true correlations in the population, they will change over time. So we need a model that also accounts for this. Later on, this is the DCC model, the dynamic conditional correlation model. It's an extension of the CCC model that also allows for more flexible and time-varying correlations. Estimation for the CCC model, if we go back one step, the estimation is done in two stages. We first fit the univariate gauge models to each component series, and then we form the residuals. That is, we take xt and multiply it with the inverse of the diagonal volatility matrix dt, and then we estimate the constant correlations in the matrix R by using the standard correlation estimator. You can also do it in one step. That's one alternative, but again, in practice, I would guess one would often rather use the dynamic conditional correlation model or the DCC model. Now, in the DCC model, the unrealistic assumption of constant correlation is dropped, and you rather have a dynamic evolution of conditional correlations, which is also evident in most financial data series. So what's in the DCC model of Engel and Sui? The correlation matrix is now RT. It is time dependent, and it's determined by this equation here. You decompose it into this matrix QT, and this product of this matrix QT multiplied with its own transpose, and then QT is assumed to come from this equation: 1 minus Xc times Q bar plus and so on and so on. As you can see, we have again the time series data, the time series itself in the process, and Q is the unconditional covariance matrix of Y. And we have several parameters. if those parameters are equal to 0, the model reduces simply to the CCC model, so it's an extension. I don't want to go into the details of the estimation. It's readily available in, say, R. It might even be in the financial toolset toolbox in MATLAB. So it's very simple to estimate the DCC model. But be assured and be aware of the fact that both the CCC model and the DCC model, as the name suggests, they are, of course, based on the assumption that you have correlations describing the whole dependence structure. So it's a simplification in the sense that all dependence between those random variables is captured by linear correlations. So it might be an idea to use a copular model instead. So the DCC model definitely has the advantage that it can be estimated in 2 steps. It includes conditional correlations. Correlations can now be time dependent. They don't have to be constant over time. The disadvantage is, again, the constancy of the parameters. That is, the conditional correlations of all assets are determined based on the same parameters. So there is still some lack of flexibility when it comes to the parameters, which means that even though the correlations can change over time, the driving pattern and the driving law that governs the time evolution stays the same. So you have time variation, but the distribution and the stochastic law that drives this time evolution doesn't change over time because it's estimated with constant parameters from one data set. Okay. Then you can also try your hand at dimension reduction. It is possible to estimate a DCC model in quite high dimensions, say 10, 20, 50 variables. But a common approach is to first perform a dimension reduction based on factor modeling and then fit multivariate gauge models to the most important factors afterwards. So one alternative could be the principal component gauge or PC gauge, what is done here. These are quite popular and they avoid the need to estimate a correlation model. What you do is you assume that the principal components of XT, so the principal components in this, say, 50-dimensional time series, the principal components that are sufficient to describe the variance, the variation in this time series, maybe we only need 2 or 3 principal components, you assume that these principal components follow a CCC model, with, again, R being the unit matrix. That is, the components are assumed to be pairwise uncorrelated. Then the model estimation is performed by first estimating the principal components of the data of your time series and afterwards fitting univariate gauge models to the 2, 3, or maybe 4 principal component series that you have extracted from your principal components analysis based on your initial multivariate time series. So this is also one thing you can do. So these were some multivariate volatility models that you can use. It is the CCC model, the DCC model, exponentially weighted moving average. There are numerous other models around, but I guess these are the most basic ones you can use to model financial market data. So next, we'll talk about model diagnostics to see which model fits the data best. So this is actually done, it can be done on 4 steps. This is taken from the excellent QRM textbook by McNeil Frey Emrechts. What you can do is you can do a preliminary analysis, then do an analysis in the time domain, fit different models, and then do a residual analysis and compare those models and choose the model that fits the data best. So a preliminary analysis could be done by simply plotting the data, checking the plausibility of a stationary model, and as we have several models at our disposal for removing trends and seasonalities, we can apply these. However, these effects are relatively minor in daily or weekly return data. We've seen this in the data for yearly and monthly revenues in Germany. But if you take daily or weekly data, you often will not find a trend or any seasonalities. You will rather find this at the monthly or yearly annual basis. So You can try your hand at removing trends and seasonalities, but most of the time with daily stock market data, this will not be enough, and you will probably not even see a trend or seasonality. Okay. When longer data windows are considered, the assumption of stationarity becomes more questionable. With daily data, it is probably the case that you will not need to remove a trend or seasonality. But again, this could be the first test and the first step. Check your data, plot it, and see if this assumption of a stationary model holds. Then you can use the analysis in the time domain. You can employ parallelograms, tests like the Young box test to test the raw data and their absolute values to check if the data is generated by a white noise process. Now, if this hypothesis cannot be rejected, you don't need to continue at all. If you see that the data you have comes from a strict white noise process or a white noise process, you're done. You don't need volatility modeling, you don't need gauge model whatsoever, you're done. You have a white noise process, you don't need to go any further. Instead, you can then simply assume it's a white noise process, fit a simple unconditional distribution to the data, and again, you're done. However, it is not likely that daily risk factor returns, stock market data, etc., that they are a white noise process, that they follow a white noise process. So you will probably see in the parallelograms of the absolute data, serial dependence, you will see that the Young box test is rejected, and this is where gauge models might come into play. If the parallelogram of the raw data shows evidence of serial dependence, you can also consider an EWMA model for the conditional mean. So you can model the conditional mean and the volatility. Then next, if you see that you have serial correlation, serial dependence, you need EWMA, you need gauge models, and you need some alternatives that you will fit to the data. And you can also fit various EWMA, various gauge models, and then you have to choose the best model. Might then be chosen based on model selection criterions. For example, you have AIC, archaic information criterion, base information criterion, BIC, the Kullback-Leikler information criterion. And this only says that you already know that you need some kind of model for the conditional mean, that you need a model for conditional volatilities. You just don't know which model best fits the data. And then you use these model selection criteria and you choose the best fitting model. So having identified a suitable model specification, there exists a number of possible fitting methods, and then, for example, you can use maximum likelihood to fit those models to the data. Last but not least, you do a residual analysis and you compare those models. You calculate the residuals from the fitted models, and if the model is correctly specified, we know that the residuals should behave like a realization of white noise, because that's the assumption, right? We assume that this is a process with a conditional mean plus conditional volatility plus disturbances or innovations that follow a white noise. If you've specified your model correctly and you calculate your real data minus the predicted values from your model, what you are left with is a realization of the disturbances, and they should follow a white noise if the model is correctly specified. So again, you can check this by analyzing the parallelogram. If there is evidence for serial correlations in the residual, probably the model's wrong. You can also use so-called portmanteau tests, which might be used to formally test if the residuals behave like a white noise process. And if there remain several suitable models, you can then select the best model based on model selection criterions. Okay, so let's make a practical example. We've seen the models, we've seen the model diagnostics, and now let's bring this to the data and do a practical example in R. Now, we will apply different models for univariate model, and we then will also do a multivariate dynamic model. So as data, we use the daily stock prices of Morgan Stanley, Microsoft, Goldman Sachs, and in the following program, we first download the data from the internet and calculate the unconditional correlations. So actually, let me correct this. This should be a third bullet point right here. So Morgan Stanley, of course, is the third stock. So let's first download the data. We take library T-Series. This is where the data is included. Microsoft, Morgan Stanley, and Goldman Sachs. We put the price vectors together into a matrix. So P is C-bind price 1, 2, and 3. This is a matrix with 3 columns with the 3 stock prices. And then Y are the log returns. We take the differences of the log prices. So Y, these are the log returns. Let's then calculate the unconditional correlations. As you can see, the unconditional correlations go up until 82, 83%. And we can also look at the summary statistics, minimum, mean, etc. For the prices, you can see we find the usual stylized facts on financial market data. Negligible daily mean return, and it's slightly skewed to the negative side. So slight losses, small losses have a higher probability than, say, for example, small increases in small price appreciations. Now, let's plot the data. As you can see, we have the financial crisis in between. So we have one very large volatility cluster in the middle, and also some periods where we have relatively calm log returns, especially here at the end. You can see it's rather calm here, and high volatility in between with all those 3 returns. We then estimate the gauge model. So first of all, we download the index prices, the S&P 500. We again determine the log returns, and now we clean the data from its mean value. We calculate the mean value and we subtract it so that the demeaned values Y, the demeaned series Y, has obviously an expected return of 0. Okay, so this is the demeaned series of returns. Let's continue. We have to load the library fgauge. This is probably the best package in our to estimate a gauge model. And then we want to apply this to the S&P 500 data. Later on, we'll do this for our 3 stocks, individual stocks as well. And we fit a gauge model, gauge 10, 40, 41, 11, 11. And this here, 5 and 6, they look the same. The difference is that as a default, it will use normal innovations for the disturbances. And in this case, this is I think one has to be careful. I think this is a student T. If it's if it is SSTD, this is a skewed student T distribution. So these are T distributed. Yes, we have it here. SSTD is a skewed T distribution. So normal T distribution and skewed T. So these are the 5 different models we are trying out. So we have gauge fit, gauge fit, gauge fit, gauge fit, save output in res, and we're saving it, and we can then plot it. So this is the original data for the S&P 500. These are the estimated conditional volatilities of the gauge model with skewed T models, skewed T distributed innovations. Not surprisingly, the estimated conditional volatilities, they peak at this point. This is quite clearly the financial crisis. So the estimated models make sense. If we compare the log returns with the estimated volatility, so plus minus 2 times the estimated volatilities, actually this looks fine. It looks like the log returns, the actual log returns, quite nicely into the this bandwidth of the estimated 2 times of the estimated conditional standard deviation superimposed on the log returns. Then let's look at the autocorrelation function of the squared returns. Again, we can see there is considerable series correlation. This is where it is not statistically significant, but as you can see, we have significant highly significant serial dependence in the time series of squared returns. Now let's look at the autocorrelation function of the standardized returns, meaning that we are now taking the returns, the standardized residuals, we take the returns and we standardize by the estimated estimated conditional volatilities. And as you can see, we are able to remove this autocorrelation almost completely. It is now statistically insignificant and close to zero. So this looks like we've done a good job by choosing this gauge model with skewed t distributed innovations. Same with the autocorrelation function of the squared standardized residuals. It's just statistically insignificantly different from zero. And then let's plot the standardized residuals. As you can see, we have one outlier here, but apart from that, if we leave this out, it looks like white noise. We have almost no serial correlation over the time series. And again, this looks quite nicely. We can then do a QQ plot of the residuals. We have assumed that the innovations come from a skewed t distribution, and as you can see, the residuals are almost all lying on this line, on this black line, implied by a true skewed t distribution. Meaning what? Yes, the residuals are distributed according to a skewed t distribution. If we were to find something that looks like this, this would mean that the residuals are definitely not distributed according to the black line, which is a skewed t distribution. But in this case, this looks fine. So the residual analysis also tells us that this model fits the data quite nicely. So let's do something else. We now want to do a multivariate model. Again, we first download the stock prices and derive demeaned returns. We download the stock data of Microsoft and IBM. We bind those price vectors together to a matrix. We calculate the log returns and we calculate the unconditional means to get demeaned series 1 and 2, and we extract the length of the vector. We then move forward with an exponentially weighted moving average model. We initialize the model. EWMA is a matrix. We set lambda equal to 0.94. We calculate the initial value for the covariance matrix by taking the unconditional covariance of the demeaned time series. We then write the variances and covariances in EWMA 1. That's the first line. So it's C of S and C of 1, 4, and 2. And then we have a loop that runs through the data. So S is lambda times S plus 1 minus lambda times T at this point. And we need a matrix and vector multiplication times this vector. We have to convert the matrix to a vector, EWMA, and so on. Calculate the correlations, and then we continue. And what we get is the conditional variances derived from this exponentially weighted moving average process that goes through the data, weights those observations, and calculates the conditional variances. Again, we can see we have high volatility here, which should be close to the financial crisis, and we have low conditional volatility here before the financial crisis. Those are the conditional correlations derived from the EWMA model. It rather looks a little weird. We can see correlation is definitely time varying between -20% and up to 80%, but just up until this point, we have no idea how to verify the validity of this estimation, of course. So next, we'll estimate a dynamic conditional correlation model. We again take those demeaned time series Y, first and second column, and we fit a gauge model to both time series, write down the estimated coefficients of F1 and F2. We generate the start values for the DCC model. So we need A, A, B, and DCC parallel, which is a vector with the parameters. We estimation is a typo here. We estimate the model DCC results equals DCC dot estimation with these parameters. Actually, this is standard in FGARCH, and the results is DCC row, DCC results, $DCC, second column, and these are in I think the red line, these are the estimated conditional correlations from the DCC model compared to the conditional correlations of the exponentially weighted moving average model. They are close, not exactly the same at all points. And then you would need, again, model diagnostics to see which model fits the data best. Okay. Any questions concerning the multivariate risk models and this practical example? You can try your hand at this at home. Simply copy and paste the programs and maybe apply to a different set of data in the T-Series library. And then you can model this all yourself. Okay. So next is sources of risk, and we can have a first look at some fundamental risk factors. We're now moving away a little bit from time series modeling, but we now want to talk a little bit about fundamental risk factors and how they can be combined into a model of financial losses. The idea now is, I've mentioned this before at the start of the lecture, that you can do both. You can first try and model financial losses directly, but you can also do more of a modeling job and think about the fundamental risk factors like interest rates, market movements, default rates, and different other factors that actually drive profits and losses of a given risk position. So we are now looking at fundamental risk factors. We are modeling those fundamental risk factors by using a probability space on which all still to be introduced random variables are defined, and we are interested in the value of such a position as a function, as a random variable on this probability space that depends on certain risk factors. Now, for those of you who don't know what a probability space is, this is simply the mathematical model from probability theory that is the foundation for all random variables and all stochastic modeling. Now, what it actually includes is we have omega, which is the result set, so the set of all fundamental events. In this case of a dice, it's 1, 2, 3, 4, 5, 6, and we then have F, the event algebra, or also called sigma algebra, which is the set of all those events and all subsets of events on which you can define P, a probability measure, and the probability measure P assigns a probability to all those elements of the sigma algebra. So it could be that omega is 1, 2, 3, 4, 5, 6. F is not just 1, 2, 3, 4, 5, 6. It also is 1, 2, 3, 4, 5, and 6. It's the empty set. It's or the set of all for example, the set of 1, 3, 5, 2, 4, 6, and so on. And then P assigns a probability to all those elements of the sigma algebra. So it's a set system on omega. It contains omega itself. It's closed with respect to complement formation and countable associations. That's the definition of a sigma algebra. Okay. Now let's turn to risk factors. We assume we are given a certain time horizon, delta, for example, 1 day, and the loss from the investment in these financial instruments in the period is given by the loss between S and S plus delta is equal to minus the future value minus the present value. In this definition, you can see that if the position increases in value, if it appreciates in value, it means that actually a loss is a negative number. No, a loss is a positive number and a profit is a negative number. So be careful with this negative sign here before this equation. At time S plus delta, we obviously know which loss we've incurred. So L is observable at S plus delta. At point S, L is not observable and it's a random variable. So we need to define a loss distribution. The distribution of L, S until S plus delta is referred to, first of all, as the unconditional loss distribution. And we can also distinguish the conditional loss distribution from LS to S plus delta if we take in the condition that all information is known up until S and incorporated in the conditional distribution. Now in practice, one often uses the term profit and loss distribution, P&L. And this is the distribution of those changes in value, Vs plus delta minus Vs. That is, if you take the loss distribution and switch the sign, again, profits are positive, losses are negative, then you have the P&L distribution. If you are only looking at the losses, maybe even cutting off the profits, then you have the loss distribution. Now, this is frequently done in practice, especially in actuarial science and insurance mathematics. Why? Because in the insurance business, you're only looking at losses. So you cannot generate any profits from, say, a car theft. That is why you can only incur a loss or zero. That's your ideal situation. So in this case, you will look at loss distributions and you will truncate the profits altogether. Now, instead of this period S until S plus delta, you can standardize this. So you can look at equidistant points in time. So you simply say L t plus 1. So you are at t. You're looking at the next point in time, t plus 1. So L t plus 1, the loss distribution is given by minus future value at t plus 1 minus the value at point t. We also use the variable S to look at the number of years. Payments are then made, interest is calculated, and if you break down delta into, say, daily losses, you can then, for example, set delta to 1 over 365, 1 over 250, and this now relates to the so-called day count convention. In practice, it is very important to know, are you actually counting actual days of number and referring to the actual days in a year, or are you simplifying it with actual divided by 365, even in leap years, or actual divided by 360, 30 days for each month, and so on. And this is important in practice, not so much actually in science and in research, but I only wanted to mention this here so that you know that in practice it does depend, and it's highly important, on the question, when are these payments made? And are you assuming, for the sake of calculating interest and compounded interest, are you assuming 30 days per month? Are you taking the actual number of days in a month or in a year? And these are called day count conventions. Then we have those values Vt and Vt plus 1. They are random variables. Losses are a random variable. And up until this point, we only considered the random variable Vt. And we now go one step further and model the value of the position at time t as a function of certain fundamental risk factors. Now, Vt is assumed to be a function of time and a d-dimensional random vector zt that describes risk factors. So we have Vt being a function in time t and risk factors. What could these risk factors be? It could be interest rates, could be default rates, could be future forecasted cash flows. And this function can be any measurable function. It can be any function that maps the risk factors to a certain value of your position. Very simple idea could be to say, well, for a stock return, we have or stock price, we have the return times your investment, and it gives you the value. Very simple. Oh, you can also say future is 1 plus r times the value, times the investment value, gives you the future value. This is very simple, but if you look at options, if you look at other derivatives, this function f can of course be rather complicated. Okay. The risk factors are usually observable at t. Again, in the future, they are not observable. Now, in the case of a stock investment, for example, market prices will be very relevant, but it could also be interest rates, exchange rates, commodity prices, economic ratios. And all these risk factors can be used to model the future value and thus the future losses from this position. Now the choice of the function f is heavily dependent on what we call risk mapping. This is the process of coming up with a model that tells you that these risk factors will interplay in this or that way and lead to such or such a loss in this position. And we'll see some examples of risk mapping below. Now, for a short discussion, what fundamental risk factors do you know? Which risk factors do you consider particularly important? Any ideas? Anything? We've already seen market prices, we've seen default rates, interest rates. I guess these are the most important ones. And which risk factors do you consider particularly important? Well, obviously the company specific, the idiosyncratic risk factors. If you're looking at financial instruments, most of the time they are linked to one company, and political decisions, yes, they will also have an influence, but obviously the most important ones are the ones that are company specific, and later on some macroeconomic factors might also play a role. Okay. Let's now turn to risk mapping. Some examples. We've seen risk factors together with time t forming a function, which is called risk mapping, and then this will translate into financial losses. In fact, we can simply look at the changes in the risk factors. We know zt, this is observable, or actually zt minus 1 is observable. We are now at t minus 1. The future value of the risk factors is not known. So because this is known, we can also simply look at the changes in the risk factors. Thus, the risk mapping can be represented as losses are given by minus the risk mapping of t plus 1, the former state of the risk factors plus the changes, minus the risk mapping at point t and the well-known and observable risk factor zt. So since zt is known, this is observable, we know this, we actually know this, and we can, if we know this is today, we know that tomorrow will be one day ahead. So everything is known besides the risk mapping, meaning that the losses only depend on the changes in the risk factor. So we only need to look at the changes, future changes in the risk factors. And we can therefore directly assign losses in the form of a function to the changes in risk factors. And this is the loss operator. We have a function, small tl of x, and we only need to insert the risk factors, and we can see that the losses are given by the risk factor changes, xt plus 1, inserted into the loss operator. That is the value of the loss operator for a given expression of the risk factor changes corresponds exactly to the loss that the investor suffers on his or her investment due to these changes in the transition in time from t to t plus 1. So that's the loss operator. Question now is f differentiable? In German, is it differenzierbar? If it is, we can then follow the following linear approximation. We don't know anything about f. We haven't made any assumption of f, but if f is differentiable, we can make a linear approximation and make it rather simple. What we can do is we can calculate the marginal derivatives, the partial derivatives of f with respect to t and with respect to all those individual risk factors. And it's quite simple to show that the linearized losses are now given by minus partial derivative plus the sum of the partial derivatives times the risk factor changes. And this corresponds to the linearized, we have to cut this down out. This is equal to the linearized loss operator. This looks actually rather the same. Now, what does it mean? It's very simple. You take, remember what a derivative is. It is actually a linear approximation to the function at a certain point. And what we are doing here is, if the mapping, if the function f is differentiable, you can simply substitute. You can always do this. The question is how good of an approximation that is, but you can calculate a linear approximation to the loss function by taking and by including those partial derivatives. Problem is, if f is a linear function, this is actually not an approximation, this is the loss operator. If f is a highly nonlinear function, this will be a pretty bad approximation and will have a bad approximation. So the linear approximation has the advantage that the loss can be expressed as a linear function of the changes in the risk factors. However, the quality of the approximation is higher if the changes in the risk factors are as small as possible, or if f ideally is a linear function, and this is the case if the second derivative vanishes, if it becomes zero. Quite clear. Now, remember that we've already talked about conditional and unconditional models. Now, if we were to use a time series model, this would be a conditional model. If we were to use just a simple t-distribution, a simple normal distribution, remember that this would be dubbed an unconditional distribution. The difference is that obviously the distributions will be conditional or unconditional, and conditional always means time dependent. In risk management, almost always in financial econometrics, if you ever hear the word conditional, what is meant is time varying. So this is one thing we need to remember here. What will result is that we are taking not the distribution of the risk factors, but the conditional distribution of the risk factors, saying that we have incorporated all available information up until point t. So this is what is meant by conditional modeling in this context. Obviously, in most cases, these are two completely different models. The conditional and the unconditional distribution will not necessarily be equal to each other, only in some cases, but most of the time this is a completely different way of modeling your financial data. When you use a gauge model, you obviously get a conditional model, and I don't need to go into too much detail here again. Now, this is just an example again of a time series, and you can see you have serial correlation, you have volatility clusters, so you need a conditional model. Okay, advantages and disadvantages should be clear. I think I can skip this now. This should be rather clear. If you take a conditional loss distribution, this is equivalent to the conditional probabilities of a loss LT plus 1 being smaller or equal than L, under the assumption that you've incorporated all the available information up until point T. Okay, this is also sometimes called dynamic risk management in contrast to static risk management. Why dynamic? Because you are able, by the use of conditional time series models, you are able to account for the dynamics and the time evolution of your parameters, of volatility, of your time series in general. So this is dynamic risk management. If you were to use unconditional distributions, I would call this rather static risk management. And capital market data obviously is very dynamic most of the time, so we'll be using dynamic models on a regular basis. Okay. Now we have 3 examples for risk mappings, and because we've already been quite quick in this lecture, I would ask you to look at these 3 examples at home and try to understand what is done here and concentrate on the risk factors and the risk mapping. We have a stock portfolio. The second example is a European call option, and the third example is a bond portfolio. All these 3 examples are quite different, but it is very interesting and very instructing to see what are the risk factors and what is the risk mapping. Now, in case of a stock portfolio, it's rather simple. It's quite challenging in the case of a European call option. And in order for you to understand this, you need to know the Black-Scholes option price model. So please look this up at home if you're not familiar with the Black-Scholes option pricing model, that at least you know what the pricing formula we are using here, what the pricing formula is all about, and what a European call option is. With the bond example, it's actually quite simple. We have different risk-free zero coupon bonds, and we include this in a portfolio and then look at the risk factor and the risk mapping. Okay, so I would ask you to do this at home so that next week we can talk about this in more detail, so that you can fully appreciate the sense in choosing different risk factors and choosing different risk mappings in order to arrive at a loss distribution for these three instruments. You could have just taken the prices, but we want to do a more in-depth modeling of those risk factors and those losses, and you need risk mapping for this. Okay. Do you have any questions on multivariate volatility models and the general idea of looking at risk factors to model financial losses? Okay, if you don't have any questions, we can stop here, I think. We are well underway in our lecture, so let's stop here and continue next week. Thank you.